For a 65-year-old, $1,000 a month is probably actually cheap for long-term care insurance, right? And so if you think about $20,000 in closing costs, that's about 20 months of premiums that we pay down. And now we have this big line of credit that we're going to use as our long-term care solution.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
So welcome back. This is episode 121. In this week's episode, we're going to dissect a reverse mortgage. We have a special guest. We'll talk about some of the pros and cons and give you some more information to figure out if a reverse mortgage could make sense in retirement. So I'm very honored to have Mitch Cooper with us. Mitch comes to us from Mutual of Omaha. He specializes in reverse mortgages. Welcome, Mitch.
Yeah, thank you. Happy to be here.
Yeah. And this is definitely a topic that I've wanted to talk about for a while because it is, I guess you could say, another source of retirement income that a retiree could tap into, right? I mean, the dream, I think, for most people is get your house paid off, right? And now you're set for retirement. But what if one of your largest assets is your house, and, how do you tap into that?
Yeah, absolutely. It's just another option, right? And it's another retirement income planning tool that is kind of in the toolbox. And it's just figuring out when's the right time to put it in place, or if it's the right tool, or, who it's for. But yeah, for the average retiree in America, 2/3 of their wealth is in home equity. So then you kind of go, okay, but how do we access that safely and strategically? Because the number one thing we want is a roof over our head, right? That's the primary purpose of a home.
Yes. Maslow's hierarchy of needs, right?
Right, exactly.
So talk a little bit about a reverse mortgage. How, when is someone eligible for it? Can everyone do it or only certain people?
Yeah. So the biggest one is the age requirement. So at least one spouse needs to be 62 for the FHA reverse mortgage. There is some proprietary programs that go down to age 55, but that's going to vary per state. And typically we look at proprietary when the home is worth about 1.2 or higher. And even in that case, they could still do the FHA, depending on kind of what their circumstances are. So the proprietary 95% of reverse mortgages nowadays are FHA reverse mortgages. And that's going to be 62 years and older. And then we just can't loan like a traditional loan. We can't loan 80% of the value of the house or, 70% or anything like that. We're much more conservative. That's set by the FHA. And that's a factor of how much we can loan is a factor of their age and interest rates. So the older someone is, the more value of the house we get to loan on, and the lower the interest rate, the more we get to loan on. And so as we're, here in October of 22, and we have rates rising, that's bringing down how much someone can qualify for. And so they have to be in a pretty strong, for most clients, a 50% or more equity position, meaning they owe less than 50% of their house in today's rate environment.
Okay. And that's just standard, or if you're like 72, can you borrow more than 50%? Or
with today's interest rates, 72 is probably a little less than 50% loan to value.
Okay. So the older you get, the less you can borrow?
No, the older you get, the more you can borrow. So a 62-year-old right now is near the 30% loan to value. And so we can really only loan around 30% for a 62-year-old.
Oh, okay. So if your house is totally paid off, you have no mortgage, you could only do a reverse mortgage if you're 62 for about 30% of the equity?
Yeah, day one, that's kind of what you qualify for. And there's some limits on how much. You can only take 60% of that the first year, and then they allow the rest to be available after that. There's some kind of different limits, but most of our clients are paying off a traditional mortgage with a reverse. So we'll take maybe a 78-year-old and it's worth $500,000. Maybe they owe $215,000. And we're coming in and we're going to pay that mortgage off. So they're not actually going to receive funds from the reverse, but they're not going to have to make that $1,800 or $1,500 or $1,000 mortgage payment every month. And that's where the cash flow advantage comes from.
All right. So you're kind of freezing their mortgage payment. So if you do that, and you mentioned interest rates, so there's interest that someone's paying, right, on a reverse mortgage, or will be paid, I should say, or is accruing.
Yeah, the simplest way to think about a reverse mortgage is it's just a mortgage in the sense that it's just a lien on the property. We don't own the house. We just have a lien so that even when you go to sell, we get paid. But we don't require a monthly mortgage payment, right? That's kind of the difference. It's just a mortgage that doesn't require a monthly mortgage payment. And so, yeah, there is interest. And the reason it's called reverse is because on a traditional loan, you're paying it down. So every month your loan balance gets lower. On a reverse, every month your loan balance gets a little higher. So you owe a little bit more each month. That's the reverse part, is that the loan is growing. And then it just goes until the last borrower permanently leaves the house. So we're a lender that's patient. We don't know when we're going to get paid. It could be 10 years, or it could be 25 years, or it could be 35 years, right? As long as one of them's living in the house, paying the property taxes and homeowners insurance. And if there are HOA dues, they're paying that as well. Then they don't have a mortgage payment, right? And they're able to live in that home. And, housing is the number one cost in retirement. And so that can be a really big deal for a lot of people to free up that cash flow, but still have the protection and shelter, back to the hierarchy of needs, right? You're there taken care of without the mortgage payment.
Okay. So that you talked about the taxes and like if somebody had an HOA fee, how does that work? Does that still get escrowed like it would with a traditional mortgage?
No. So they'll live like they're free and clear. So those are their responsibility. There is kind of a reverse mortgage version of an impound account, and they would take a portion and put it aside to pay the property taxes and homeowners insurance on their behalf for their life expectancy. So, it could be for 12 years or, kind of if they're older, that kind of a thing. But it could be a pretty big chunk of money. It could be 60, 70, 80,000, kind of depending on what their property taxes and insurance are and how old they are. And they just put that aside. And then every year as they pay those bills, it gets added to the loan balance. So it's not money you owe until they pay the bill.
Oh, so wait, who's doing this? The borrower is setting this aside or the lender?
The lender is. Yeah. So it's money that wouldn't be available to them.
Oh, so if you do this, you then don't have to be responsible for your taxes and potentially other like HOA fees on your mortgage or your property?
It won't pay the HOA. It'll only pay property taxes and insurance. And it's only for a certain amount of time. It's kind of until that bucket is used up.
Oh, so your life expectancy.
Yeah.
Okay.
Mm-hmm. Yeah, that's how they set the parameter. But if, your property taxes kind of skyrocket, you could use that bucket too soon, or insurance. That's probably a better example. You could use that bucket prior, or if things grow slower, then it could last a little longer. But that's kind of how they get the estimate of that bucket. Okay.
So is that always the case with this feature, or is that something that the borrower chooses?
Yeah, so they call it a LISA, life expectancy set aside. And so it's something that they can volunteer for. They can just say, hey, I don't want to pay those. You guys deal with it for the next 12 years. Or it's something that would be, there is income qualifying for reverse. And so we have to show the ability to pay the property taxes, homeowners insurance, and that kind of thing. But we also have to show what we call willingness, which is a history of lates, right? And so if there's too many lates on the credit or late HOA dues or even late property tax payments, then they could be required that they have this set aside, because then they know they're going to get paid on time for at least a certain amount of time.
Okay. And so, because one thing I've read about and even proposed to some clients is like, hey, you've got, a lot of equity, like maybe set up like a home equity, a reverse mortgage line of credit as like a fallback, that if there's unexpected expenses or maybe like the stock market's down and you want to stop withdrawing on your portfolio to give it time to recover, maybe you could use this as a stopgap or a way to fill that lost income or income you put on hold. Is that something people can do?
Yeah, so that gets into kind of the most beneficial, most strategic use of a reverse is putting in this line of credit. So, the best way to think about this is, let's think about a free and clear house. And that, we'll say they qualified for $200,000. Well, they don't need to take that out. It's not a cash out refinance. They could just leave that in the line of credit. And so it's there, it's liquid, it's available. Different than a home equity line, a traditional home equity line. If you remember 2009, all the home equity lines went away or got frozen. We can't do that on a reverse. So it cannot be frozen. We can't reduce it. We can't lock it, and we can't cancel it. So as long as they're meeting the loan requirements, live in there, pay the property taxes and insurance, that line of credit is there. Even if we do see a 2008 home values go way down, that line of credit is available and insured by the FHA. So, Mutual of Omaha's, mutually owned, and we're 110 years old. But even if we go away, the FHA is backing up that line of credit. And so it's a very liquid, tax-free bucket. Right? It's a loan, so there's not income tax. It's not affecting provisional income for Social Security. So, yeah, you do have something like this year where we're down 20 some odd %. And that's a really bad time to start selling stocks to generate income. So that's a great time to, okay, we're going to stop pulling from here and we're going to pull over on our reverse. Let's say we need 80,000 this year to live off of, or, again, you're not paying tax. So 80,000 is 80,000, and you can start taking that. And maybe next year looks a little better. You stop taking off the reverse and go back to the stocks. And it's really flexible like that. It also has a growth feature. The line of credit grows at the same interest rate as the loan. And again, you're not making money. You're just having more available borrowing power. And so that becomes a strategy of putting it in place before you need it, because that 200,000 can grow and grow and grow and grow. Where 10, 12 years from now, maybe you have 500, 600,000 available to you. Again, still tax-free. You could pull it all at once. You could turn it on as monthly income. You can use it for long-term care. There's no requirements of what you use it for, right? You just call them up and start taking money.
Okay. Do they give you a checkbook with it, like a home equity line of credit?
It's not quite that liquid. It's a phone call, and then they'll call and verify the next day that it was in fact you. You can set up for direct deposit ahead of time. We generally tell our clients expect about 5 days from request to money in your account.
Okay. And so let's just walk through this. So let's say you get this $200,000 line, reverse mortgage line of credit. You haven't used any of it yet. Is it accruing interest while it's sitting there as a line?
Yeah. So the line of credit every month, the best way to think about it is if you've ever had a credit card send you a letter and say, hey, you used to be able to borrow 5,000, now you can borrow 6, right? And so you have more borrowing power. That happens every month as a feature of the interest rate. So that's where we have these pros and cons with the high interest rates. Well, if you have this line of credit in place and now we're coming up on 6, 7%, well, now your line of credit availability is growing at 6 or 7% a year. And it's just available borrowing power that is just growing and could potentially exceed the value of the house. If we do see 2008, let's say it grew to 400,000, all of a sudden the house is worth 300. Well, you still have 400 available in that line of credit.
Wow. Okay. But maybe you answer this, I just didn't understand. But so you don't tap it yet. You're not accruing interest, right?
Only on so you have to leave at least $100 on the loan balance. So, a few bucks a year. But the closing costs are traditionally financed into the loan. And so that's where you could just leave them there. And, depending on reverse mortgages are not an inexpensive loan, right? And that's the biggest thing when we sit down with clients is this your last house? Because you don't want to be doing it every 2 years. It's not a $500 HELOC. It can be up to, for high valued homes, we can get up to $30,000 in closing costs. And so it'll be financed into the loan. It's not cash out of pocket, but eventually that's getting paid, right? Hopefully out of the estate when the home's paid off.
Sure. You're paying interest on that. So if it costs $30,000, you're paying 7% interest. I mean, you're paying $2,100 a year of interest.
Yeah, just growing onto the loan balance, and then hopefully
that you probably would want to pay out of pocket or pay the interest down if you were worried about the long term. If not, you just let that keep rolling, I guess.
Right. You kind of let it go come out of the house. So the true strategic use of it is, you pay those down to about $100, because every dollar you pay down also becomes available line of credit. It's rotating. So if you pay down $20,000 in costs, it's now $20,000 more in your line of credit. And then, now we're only growing interest on $100. And you just think of that as like an insurance policy. A lot of people where we use this as kind of an alternate long-term care, solution is, okay, for a 65-year-old, $1,000 a month is probably actually cheap for long-term care insurance, right? And so if you think about $20,000 in closing costs, that's about 20 months of premiums that we pay down. And now we have this big line of credit that we're going to use as our long-term care solution. And if we don't use it, it costs us the $20,000 and some interest on $100. And if we do use it, it's just coming out of our home. We're letting our home pay for our in-home care.
So that now let's say you use the line of credit, you pull $50,000 from it. Could you decide if you wanted to pay that down while you're in the house?
Yeah. And then it just becomes back to available line of credit. It's always rotating.
Okay. There's no prepayment penalty or anything like that usually?
No, there's never a prepayment penalty. No. Yeah, so it's very, very flexible. And that's where, you can turn on monthly income, you can turn it back off, and you can do that at any point. There's so many uses to that line of credit, and that's why it's so strategic and useful. We have spouses that build that up and are paying it down while they're still working, because they know if one of the spouses dies, they're in trouble, right? They have the loss of Social Security income and a pension, and so that's when they're going to turn the income on. So they're letting that line of credit grow. They're even paying it down a little bit, so that once one of them passes, then they have that alternate income source. coming off the house.
And then if you, let's say, use it all up, right? Your line is done. You'd have to then pay it down to access more of it, right?
Yeah. So, there's a couple different ways of looking at it. But once the line of credit, if you're just pulling, okay, I need 20 grand, right? And eventually you use the whole thing. Then yeah, there's no future access without paying it down. Or refinancing, which, kind of gets into its own thing, but you'd have to have higher values or lower interest rates or something like that to try and get more money out of it. But that's a whole new loan, right? You're paying off that reverse and getting a new reverse. But if you do turn on what we call it tenure income, which is TENURE, but it's essentially annuitizing the line of credit. If you have that kind of income, then it will continue. Even if you outlive, if you live to 110, yeah, the line of credit bucket's gone, but you still have that tenure income. As long as you're living there, paying property tax insurance, right, HOA, then that income's still coming. So we like tenure income for that protection, right? If, you can do term income where you say, okay, I need $5,000 a month. Then we go, okay, that's only gonna last 4.5 years. Then that income would stop. But the loan is not due. So as long as they're still living there paying those fees, then they just don't have a mortgage payment and they're living in the house. But typically, we typically see term income for a long-term care event. That's where we go, okay, mom's got a free and clear house. We need $7,000 a month. And we know it's going to end. And at that point, they're going to sell, take the rest of the equity and go into a home or something like that, right? If mom outlives, that kind of income, because typically they're needing that for a reason. And this is why we always stress putting it in place early and using it alongside your other assets, because it really works best as an asset protection tool. If we still have $500,000 in an IRA and we're starting to draw that down because of long-term care, well, if we can come in with some income and kind of work them together, then they both last longer.
Yeah, and this is also tax-free, right? So, but I guess it depends, what somebody wants to do, what asset they're trying to leave behind as well, right, to their kids, and if they're going to stay in their house. So in this scenario, this is someone staying who can still have home care, right? Let's say you did the reverse mortgage, you can't be in your home anymore, and now you're going to go in a full-time nursing home. Would the house then need to be sold?
Yeah, once the last borrower permanently leaves, the loan is due. And so let's say they owe $300, 9 out of 10 adult children don't want the home. They want the money out of the home, right? And so they're going to sell and take the rest of the money and help use that to...
Or they need the money maybe to pay if they're not on Medicaid, right? They might need the money to keep paying. Or Medicaid's going to force them to sell the house to go on Medicaid.
Right. So then they would take the rest of the equity and use it towards that at that point. Probably because they just need the access to that wealth, in that scenario, right? They're now moving into a full-time, nursing care. Then they're probably wanting the rest of that equity out anyway. But yeah, the loan is due at that point. So as far as, what they want to leave behind and things like that, I do think that that's kind of, I would say finance is pretty much all behavioral, right? It's all psychological and we know the math and we do the wrong things all the time. But one of the things we tend to do is we tend to leave the house in our mind for legacy, and we'll drain all these other assets. And I think I stole this analogy from Wade Pfau, but he talks about getting water out of a well. If you had a bucket and you're just trying to get water out of the well, you don't really care where the water came from. You don't care if it's rainwater or snow runoff or whatever. You just need a bucket full of water. And that's kind of how we try to educate to look at legacy. There's some different tax consequences here and there, but mostly you go, okay, what if we could protect the IRA and keep it growing and not so concerned with home equity? And the research actually shows most of the time we increase the total estate left behind by using the reverse mortgage strategically, because we're protecting those growing assets, and so it's more, you get more estate, don't worry so much about, it's less house, sure, but you get more estate.
And probably, right, over time, if you have stocks in your portfolio, those have outpaced most real estate growth over time, right? Historically, so you're better off tapping the house that's probably not going to grow as fast and leaving the portfolio if you could.
Well, and the nice thing is the house still grows. You're not changing that aspect of it. And so my grandparents have had a reverse for 13 years. They have more equity today than they did 13 years ago, even though they haven't made a mortgage payment in 13 years. And so if they were to sell today, they'd walk away with more, but they've also saved over $200,000 in cash flow of making a mortgage payment because the house is appreciated way faster than the loan. But but they have a house to live in, and that's the point, right? And
yeah. So what if some people I know, and this might be outside of your scope, but we talked about Medicaid, right? Is one idea you gift your house to your children or you put it in a trust so that you start the 5-year look back period for Medicaid. Can you do that and have a reverse mortgage?
Yeah. So mostly for questions like this, I say, well, we need to talk to an attorney, right? Or someone that understands it better. We have Medi-Cal. I'm over in California, and they have limits on assets and things like that. And I know you just have to be careful with how much is in the bank account from talking to attorneys and working through, but the reverse doesn't affect that. And Medi-Cal here also, they lien the house. They pay for the care, and then they come in and lien the house at the end. And a lot of people don't realize that. So, we have Medi-Cal specialists and Medicaid specialists. So you might as well do the reverse and have control over it instead of them coming in and taking care of it. But yeah, there's definitely, we can have the house in a trust. It has to get approved, of course, but revocable trusts are almost always okay. And have it trust that way we can avoid probate and, when things do pass and get the loan taken care of.
Okay. So I guess the biggest negative with this for people, there's a lot of positives. I guess the negative would be the cost, right? The cost, like you said, to take this out. And then also the fact that you are paying interest, right? And the fact that we have higher interest rates now, you're paying more interest than before. So at the end, there might be less if you hadn't done this, but it's also all the positives of what it's doing for you, right?
Yeah, the biggest con is costs. And that's why we always try to, it doesn't have to be your last house. We've had clients that have done 4 of these. They keep moving and keep telling us it's going to be their last house, and they go, no, this time we're for real and we're not selling. We're like, okay. And they've walked away with more money every time, right? And that just because of the house appreciating. But that's the biggest thing is it works best on your last house when you're no longer so concerned about home equity. You go, okay, but if I can live here, have better cash flow, have a better probability of my money surviving me instead of vice versa. Everything's more secure. I know that I'm in this house and I'm good. Then you're not so concerned about, because home equity just eventually becomes this piggy bank we can't really touch, without selling. And so it's not the best wealth source when we're in retirement income planning. And so that's where once we have those concerns, we're not so concerned about the cost. It's about what it's going to allow us to do. And again, the power of the reverse is what happens outside the home. Right. And protecting those other assets is the key to the whole thing. You will certainly outpace the cost if you do this correctly. Right. And you don't wait till the very end to put it in place. You put it in place sooner and use it strategically for down markets or, this and that. Or there's so many things you can do with a big tax-free bucket like that. There's Roth conversion strategies. There's just so many things. And so using it like that as a strategic tool is where the power comes in. And that's where we help. I always call it's an asset protection tool. Let's protect those other assets with it. And that's where the power comes in and outweighs the cost. But everything, right? If there's not enough value, then the costs are a problem if there is. And that's where when we sit down with clients, we're asking, what happens if spouse A dies? Are you staying here? What happens if spouse B dies? Are you staying here? Trying to get through the cons, the pitfalls. Are you guys moving out of state in the next year or two? Because let's wait and let's do it on that house. That kind of a thing.
Okay. Awesome. I think we've covered a lot. Is there anything else you'd want to touch on before we wrap this up?
Yeah, I don't want to put too much out at once because you start confusing everyone. But yeah, it's just kind of trying to change the thinking. Don't think of it as a poor person loan or, don't think of it as a failure. It's just another tool and trying to use it correctly and implement it with financial planners in the right way. That's the key. Makes
sense. If someone wants to reach out to you, are there certain states that you deal with, and how could somebody contact you?
Yeah. So I'm with Mitch of Omaha. We have loan officers across the country. We're in 48 states. I'm mostly kind of more on the west and middle side of the country, but they certainly can, reach out to me. I can give my cell phone number and we can find who's near them in Connecticut or wherever they are. We tend to mostly care about the client. We care about the client over the sale. And that's the important thing is finding someone that's going to educate you and not try to push you into a loan no matter what your situation is. That's the thing we don't want for people.
No, definitely not. Okay. Whatever number you think is best or website.
Yeah, they can call me at 916-768-9150. Or my email is mcooper@mutualmortgage.com.
Okay. And we'll put a link to both that in the show notes. If you go to retirewithryan.com, you can find that information as well. So, well, thanks a lot, Mitch. A lot of great information. Definitely expanded my knowledge base regarding reverse mortgages. So I appreciate you coming on.
Yeah, my pleasure. Yeah, I appreciate being on. Thank you.
Thank you for tuning in this week. As a reminder, if you haven't gone to retirewithryan.com, please go there and complete the 2022 listener survey. It will take you less than a few minutes, and your feedback is greatly appreciated. Have a great week, and I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.